All right, the last and final chapter of the semester. So exciting. Long-term liabilities, bonds, and notes. And so this is the last of the three chapters that are going to be on the final exam. And it's open book, open note. One, I don't expect you to memorize how to do ratios and financial statement analysis, so you'll be able to do that on the final by referring to your notes. And then in order to complete the bond problem, as you'll see when we get through these slides, there is two tables that you'll need that are in your textbook, and I'll tell you what page it's on here in a little bit. So
Our test is at 4:30, right?
Right.
On a Monday?
Monday.
Did they ever say why you were so late?
No. I have no idea. Yeah, because the test, the reason it can't be held at the same time is the regular classes are only 75 minutes long, whereas the final exam is 2 hours.
Yeah.
So they schedule them weird. So, yeah, I don't know why. It's late afternoon. But anyway, so corporations, when they need additional long-term funding, they really have just three options. They can go borrow short-term debt. They can go borrow one-year notes. They can do 5-year notes payable, mortgages, and the like. Or they could do long-term debt. Long-term debt could be a 20, 30-year mortgage on a piece of real estate, or it can be bonds. And bonds is the one that we're going to be focusing on today. And then the last option is you can sell more stock. Now the problem with selling more stock is with a note or a bond, you know what the interest rate, you know what that cost you. Can anybody think of what is the cost of selling stock in your corporation? What is that cost? What you're giving up is a percentage of all future earnings, because you're giving away equity. There's a famous story of a graffiti artist in the Silicon Valley who painted a mural in the Facebook offices when they were just getting started. And in exchange for that, he got shares of stock. Well, when the stock went public and then a year later, he slowly started selling that off. In essence, it's the most expensive painting ever created in the world, because he got stock in Facebook in exchange for doing this mural. And so equity is, a lot of entrepreneurs are resistant in giving up equity. So don't think that equity doesn't cost you anything. It does. All right, so a bond is an interest-bearing note. It is a formal security. They're openly sold on a bond market. You can go out and pull the marketplace pages from the Wall Street Journal, and there'll be 3 or 4 pages of bond listings and what they're trading at currently. And I'll talk about what that looks like. So it's going to give off an interest stream. So the bondholder will get a semi-annual, most of them pay twice a year, a semi-annual interest payment over the life of the bond, and then when it matures, they'll get whatever the face value of the bond is. And most bonds are in $1,000 increments. Okay? The principal is paid on the date the bond matures, and it's normally paid semi-annually. That's what as it says, most bonds are done semi-annually. And then if a bond is tied to a piece of real estate, it's a secured bond. Otherwise, it's just a formal agreement between the bondholder and the issuer, and that's called an indentured bond. Okay? And most bonds are indentured. Every once in a while, they put out, like Toyota, when they built the plant down on the southeast side of San Antonio, they issued a bond and actually tied it to the plant itself. That's long been paid off by now. All right, the two most common types are either term bonds or serial bonds, and most bonds are term bonds. The serial bonds, you'll make an issuance and you'll sell, let's say, $10 million worth of bonds. Well, you'll split it up over 4 serial maturity dates. So a quarter of those bonds will mature in 5 years, another quarter will mature in 10 years, another quarter in 15 years, and then the last quarter will be due 20 years from now, and you'll retire the issuance. Beyond that, there is a whole slew of bond structures. There are convertible bonds that can be converted into either preferred or common stock. There are callable bonds that can be dissolved by paying the bondholders the face value plus a premium normally. There's normally a penalty associated with early retirement of a bond. And so there's a whole structure of various bonds. What you need in order to solve a bond problem is you need 3 pieces of information. You need the face value of the bond, and these are very ornate documents, similar to common stock shares. They have printed on the face what the value is when it matures. And like I said, most of them are in $1,000 increments. The interest rate on the bond, how much interest is it going to pay periodically? And then lastly, what is the market rate on the date of sale? All right? Because the market rate is what the market, these are sold in an open market, it is what they determine the risk associated with the bond is worth. Okay? So this fluctuates because just like stocks are priced upon what the market perceives as risk. The higher the risk, the more it needs to pay, right? If Google for some reason issued a bond, that would be a very low risk investment because Google is very financially sound. If Radio Shack right now wanted to issue a bond, it would be very high risk. If the city of Detroit issues bond, very high risk. So the higher the risk, the more interest the market demands. So the market is always, you're going to compare what the contract rate is, the face value rate, and the market rate. If the market rate is higher than what the bond is paying, in other words, the bond, let's say, is paying 8%, but the market perceives the risk on that one day to be worth 10%, then the bond isn't paying enough. So the bond will sell for less than its face value. So rather than $1,000, it'll sell for $950. And that discount on the face value is the extra interest that the bond earns over its life. If the market rate and bond rate are equal, then it will sell for exactly its face value, $1,000. If the market rate is lower than the face rate, then it will sell at a premium because you're giving them too much interest every 6 months through the life of this bond. All right? So face, if it's equal, if it's the market rate needs more than what the bond is paying, it will sell at a discount. And if the market is less than what it is paying, it will sell at a premium. And they're always quoted as percentages. If you go look at the quotes in the pages of the Wall Street Journal, it'll say, IBM Series 3, 98. And that is, it's selling at 98% of its face value. So for a $1,000 bond, it's selling for $980. Or it could be quoted at 109. That's 109% of its face value. All right? You need to amortize this premium or discount because this is the difference in interest. So you're going to be expensing every 6 months the interest that is actually due on the bond as if it was issued at its market rate. So here's an example. Issued at face value. The market rate is 12%, the contract rate is 12%, it's a 5-year bond, and the entire issuance is $100,000. At that point, the entry is simple. It's a debit to cash and a credit to the liability of bonds payable. When the interest comes due at the end of June for the first payment, you will debit interest expense. 12% times 100,000 is $12,000. Half of that, because it's semi-annual payments, for $6,000. And then the same again on December 31st. So you have bonds payable on the maturity date and retire it. So you'll do that interest expense and debit and credit cash every 6 months for the interest. If it's the contract rate is 12%, but the market needs 13%. So you're not giving the market enough interest for them to buy your particular bond on that particular day. Well, they'll make up the difference by penalizing you. And they will only give you, in this case, 96% of the face value. So they will sell for $96,406. That's a discount of $3,594. And this is a contra liability account. It's a negative liability. So on the balance sheet, under long-term liabilities, you will have bonds payable, $1,000, less discount on bonds payable, $3,594 for a net. And then it would be a net. Just like with the contra asset account of accumulated depreciation on property, plant, and equipment. All right? So the discount is the contra account. I don't know about that. So amortizing it. This is the second part. So on the final exam, the question is going to give you the face value of a bond issuance, what the face interest rate is, the maturity, which is going to be 5 years, and then be an annual payment, and then what is the market rate on that date. So you will then use the tables, which I'll go over on Monday when we go over the problems in this class. You will determine what is the selling price of that bond, whether it's selling at a premium or selling at a discount. So it'll sell at a discount if the market rate is higher than the face rate. It will sell at a premium if the face rate is higher than the market demands. And then the second part is I give you a table on the sheet of paper, and you will amortize that over the 5 years. Okay? So in the interest rate at that point is going to be interest expense and amortizing the discount on bonds payable, which is the difference between the interest owed to the the bondholders and the cash that they receive. All right? There's two ways of computing the amortization. That's straight line or effective interest rate. We are going to be doing the effective interest rate method. Straight line is that last example, that $3,400 of discount over the 5 years, you just divide it by 10 because it's semi-annual, and then add that to the cash in order to come up with the interest expense. So the effective interest rate, I'll show you a table here in a second on exactly how to do that. So what you're going to be doing is you're going to be taking the net book value, the carrying value of the bond, you're going to multiply it by the market rate, and that will give you the interest expense. You're going to subtract that from the cash payment and then take the difference from the discount and add it to the carrying value. And then that will, in the case of a discount, that will slowly increase the carrying value until at the end of the 5 years, in the case of the final exam question, end of the 5 years, you will have the face value. Okay? So, Here's a discount. The discount on bonds payable, this is straight line, is that you're going to do that over, term of the bond is 5 years, semi-annual, and you have $359.40 every time. That's straight line. We're going to be doing the effective interest rate. So in that case, you just take interest expense of the total of the discount from the contra liability account and the cash that's paid. So the interest in total is $6,359, and that's going to be the same under straight line throughout the entire 5-year period. The effective interest rate is this is the same kind of problem with premium. Now, if the market rate was 11 rather than 13%, this is going to sell at $103,000. And now we have an additional liability of $3,769. All right? And it's added to. And then the same thing follows with that. We can amortize that over the life of the bond, do the straight line by deducting that from the interest expense, so it's less than the $6,000 in cash. All right, so let's go to the amortization. Let me find that in your book. The present value tables are in the back of the book in Appendix A. Appendix A has 2 tables. There's the present value, and so tables are, if I promise to pay you $100 a year from now, is that worth $100 to you sitting here today? No. You would be grossly disappointed if come Christmas morning you had nothing but a bunch of envelopes under the tree that says, I owe you a, Xbox 1 year from now, or I owe you a sweater, or I owe you, yeah, right? Because it's not worth cash in hand, all right? So the future value of $1,000 1 year from now is $1,100. The present value is bringing that future value back to the present day. So if $1,000, if somebody promised you $1,000 a year from today, and the current market rate out there is 10%, that's really only worth to you $909.09. Because what will that make over a year? If you invested that at 10%, you'll make $90.91. Okay? And which is $1,000. All right? So present value from 2 years is $826 because you can make 10% on that, so you'll make $82.65 in 1 year, which will bring you up to $909.09, and then you'll make another $90.91 that following year to bring you to the 1,000. So here's what the tables look like. They're a series of interest rates across the top, and then the number of periods. And they go from 4% all the way up to 14% in your book. And they go from period 1 all the way to period 50 in your book. And you can see the 10%, what the last slides just showed. Here's the 0.90909, and here's the 0.82645. So that $826.45 is worth $1,000 in 2 years' time. In 5 years' time, it's $620.92. So if you had $620.92 today, and you could make 10% on that, paid annually, then in 2 years' time, you'd have $1,000. An annuity is just the present value tables on a periodic payment. Because remember, a bond has two cash flow streams. It's going to mature at some time in the future, and then it's going to pay interest every 6 months. Well, that second one is an annuity. It's the same cash payment, the same time every year or twice a year over the life of the bond. So, if you had, what's the value of $100 1 year from now? It's worth $90.91. And in 2 years, it's worth $82.64. That's a combination of 173.55. The tables, if you look at 10% over 2 years, all it's doing is it's taking that first table and adding them up for you. So remember, the first line is the same, the 90909. The second line from the present value table was 3645. And so there is just adding that together, and the same all the way down. So the selling price is the combination of the two. It's the face value, the present value of the maturity, and then the face value of the annuity of the interest. All right? So if we had $100,000 at 12% for 5 years, if the market rate is 12%, then you go to the table and you go under 12%, and it's going to be semi-annual. So semi-annual interest, you're going to have the interest and then double the periods. All right? So the 12% you're going to look up in the table under 6% in the 6% column, and you're going to go down to not 5 for the 5 years, but the 5 payments that you're going to receive, and that's 10. And at 10, you have a factor of 0.55839. So this factor is what is in that table. If I go back to, let's go all the way back to here. So under 6%, the annuity. 6% down to 10 years. 6% down to 10 years. Oh, this is the first one. 0.55839. And then 10% for the annuity is 7.36009. If you multiply that times the $6,000 in cash that it's going to pay every 6 months, you get $43,139. So this bond, which we knew at the front, because the market rate was 13%, the face rate was 12%. So we knew it was going to be a discount because we're not giving the market enough in interest. So the total is $96,406. If the market rate was only 11%, then we would look at the 5.5 column. And in the 5.5 column, for the table 1, you'd be 58543. And then in table 2, the annuity, 7.53763. Total of $103,000 a premium. And then this is the last point here. The interest rate, you're always going to use the market rate. And where's the table? So the face value of a discounted bond is $96,406. If you multiply that by the 6.5% for the 13% market rate, you get $6,266. That's a difference of $206. Add that, now your bond carrying value is $96,672. Multiply that by 6.5%, you get 6,284, a difference of 284. Add that 284 down. And you can see, you can keep going until at the very end, you get $100,000. And that's the face value that you then would pay back to the bondholders. All right? And then this entry is just a debit to interest expense, credit to the contra liability, and the cash. If it's a premium, you're going to do the same exercise. You're going to take the $103,769, multiply it by 5.5%. That'll give you 5,709. The difference between that and the cash payment is 293. Only now you're subtracting it, because in each case you're going to get the carrying value at the beginning of the life of the bond and take it down to, in this case, 100,000. So you're going to subtract that 293, bringing the face value down to 103,476. And then multiply it again by 5.5%, subtract the difference between the cash, and continue. All right? Does that make sense? Okay. That's what I have.